Good afternoon. This is Sean Golding with Golding & Golding, here to discuss the basics of the PFIC. Any way you slice it, a PFIC, otherwise known as a passive foreign investment company, is a very complicated analysis. The way that the IRS has set it up, it's basically a punitive tax scheme in which the IRS seeks to go after significant amounts of tax for items that otherwise, if they weren't PFICs, would usually qualify for long-term capital gain, qualify dividend treatment, et cetera, et cetera. So what's the purpose of the PFIC? Essentially, well, let me take a step back. PFICs are passive foreign investment companies. They could be any type of company. But for the majority of our clients here, it's U.S. taxpayers who have foreign mutual funds, investment funds, ETFs, SICAVs, depending on how you pronounce that, right? Things of that nature. So when you have a PFIC, a fund in the U.S., for example, if you're under audit, the IRS could just go over to Vanguard or whichever company you use, get that information, subpoena, summons, whatnot. When you have a foreign investment, there's no reason at all for that foreign investment institution or company to update the IRS, issue 1099s or anything like that. They're not required to do that with the IRS, so why would they? And with those funds, as they become popular and U.S. persons become investors in those funds, most of the companies still don't want to cooperate. Therefore, the IRS says, hey, if you're not going to cooperate, here's how we're going to tax you. We're going to tax you heavy. So let's go through the basics. Typically, a PFIC is a type of investment, passive foreign investment company, in which either 75% of the income and or 50% of the assets are passive. Generally, one way I find that's a relatively simplified way to explain a PFIC is a moving box, right? You have a moving box. That's a fund, let's say. In that fund, there could be a ton of things going on, but if nothing is being distributed out of the fund, then there's not going to be any income situation at the time. So you've got Fund A, Box A, you've got a whole bunch of things going on in there, but nothing is necessarily coming out or going in. It's just shuffling around, being reinvested, things like that. When that happens, you have to report it. There's a form, well, if it's in an account, it goes on the FBAR. For Form 8621, unless you're under certain exemption amounts, it's going to be included on there as well. You're going to report the NAV and then the shares and how many shares you have at the end of the year, what the value is, things like that. But there's no tax yet. Once it starts to distribute income or there's redemptions and things like that, then you get into one of these super complicated excess distribution situations in which if the current year's distribution is more than the average for 3 prior years or less, if it hasn't been around for 3 years, 125% of that, then you have to start to do these headache calculations, add in the interest, determine how many days you held it, and then whatever the highest tax year is for that year, you have to include that. So let's say you had the fund for 3 years, and then you redeemed it on the 4th year or you sold it in the 4th year. For each one of those prior years, you're going to calculate the tax based on whatever the highest tax rate is, so 37, 39.6. Then you have to kick in some interest as well for the amount of time it was in there that wasn't distributed. You can easily get to a 40, 45, even 50% tax rate. Whereas if that same investment was a dividend through a stock, if it was a qualified dividend, let's say you're looking at 15 or 20% long-term capital gain, 15 or 20%. Even short-term is going to be based on your progressive tax rate. For PFICs, the only progressive tax rate that's applied is for the current year that you do the redemption. There are some elections you can make, qualified electing fund, mark to market. They have to pretty much be done timely. You can try to go back and do a reasonable cost statement, but it's very difficult, way more difficult than if you're doing an offshore disclosure. You may have to try to get a PLR for things like that. The other issue is, in order to make certain elections, you need the cooperation of the foreign funds. And I can tell you from experience, 99% of the time, those funds don't want to cooperate. They don't want to reveal the information to the IRS, so that the IRS has it in case there's any potential issues down the line with listed transactions and things like that. If you're out of compliance for not filing, reporting the PFIC, there's various disclosure programs in place The Form 8621 that's used to report the PFIC, in addition to the FBAR, sometimes 8938, is a peculiar form. There is no monetary penalty for not reporting it. The penalty is that the tax return doesn't close. So, depending on what type of situation you're in, if you're already in a 3 to 6 year audit, they want to go back further. They don't have to show anything more if they can show that the forms weren't filed in those prior years. There's various programs that are available. They did close OBDP at the end of 2018, but there is the updated traditional voluntary disclosure program. There are the streamlined filing compliance procedures, domestic and foreign delinquency procedures, and there's always reasonable cause, which isn't a program per se, but can be very effective depending on the facts and circumstances of the taxpayer. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.